Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know that old saying, right? We've all heard it a million times from financial advisors, in books, on TV. In the long run, stocks always go up. It's treated like this fundamental law of the universe. But what if I told you that this comforting little piece of wisdom is actually one of the most dangerous myths in finance? Yeah, let's dig into that and see why.
So let's kick things off with the classic from the man himself, Warren Buffett. What he's saying here is that a truly great investment shouldn't be about watching the price wiggle up and down every day. It should have real, fundamental value that could survive even if the entire stock market just shut down. It's a fantastic mindset to have, but it's about to be put to a serious test.
Because, a 5-year closure, that's one thing. But what about a situation where the market is wide open day in and day out, but for literally decades, it goes absolutely nowhere? What happens to that whole stocks always go up theory then?
And this brings us right to the heart of the problem. It's a phenomenon with a fancy name, a secular bear market. Now I know, that sounds super technical, but all it really means is a really, really long time. We're talking a decade or more where the stock market is basically flat, just treading water, no new highs, no real progress. And as you're about to see, these periods are shockingly common.
How common? Well, just look at this number. Over a 110-year stretch of modern market history, the stock market spent a combined 72 years generating almost zero growth in price. Let that sink in. That's almost 70% of the time where the strategy of just buying stocks and waiting for their prices to go up would have completely failed you.
And here's the cold, hard data to back it up. This table shows the 4 major secular bear markets from the last century or so. Just look at those annualized price returns. Negative 0.24%, a measly 0.11%. These are basically zero. Imagine you started investing for your future in 1966, and for the next 18 years, the value of your stocks barely budged. That's a tough pill to swallow.
This chart just illustrates it perfectly. Here's that first period. From the peak in 1906, you go through a massive panic, World War I, the market just thrashes around like crazy. And after 18 long years, where does it end up? Right back where it started. A whole lot of heartburn for absolutely zero gain.
But honestly, that was just the warm-up act. This next period is the big one. After the legendary crash of '29, it took a full 25 years for the Dow to finally climb back to where it was. A quarter of a century. Think about that. An entire generation of investors saw zero capital appreciation.
Then you've got the period from the mid-60s to the early 80s. This was an era of crazy inflation, economic chaos, political drama, and you can see it right in the chart. For 18 years, the stock market was just dead money. Bouncing around, sure, but making no real lasting progress.
And finally, we've got a period that a lot of us probably remember all too well. From the tippy top of the dot-com bubble in 2000 through 9/11 and the 2008 financial crisis, it took 11 years for the market to get back on its feet. So the really crucial thing to get here is that these long, flat periods aren't some kind of ancient history. They're a recurring feature of the market.
Okay, so after all that doom and gloom, you might be thinking investing is just a lost cause. But it's not. There's a hero to this story. There's an unseen engine that was chugging along in the background during all those awful years, quietly turning potential losses into pretty respectable gains. And that engine is dividends.
Okay, this slide right here, this is the big reveal. This is the aha moment. It takes those same 4 bleak periods we just looked at. The middle column shows those awful near-zero returns from price alone. But look at that column on the right. This is what happened if you simply took your dividends and bought more stock. A negative return transforms into a positive 6.19% gain. A pathetic 0.11% return becomes a solid 5.53%. This changes the entire picture. It's a total game changer.
Let's just visualize the difference for that 1966 to 82 period because it's so dramatic. On the left, you've got that tiny little sliver of a return from just the stock price. On the right, you have the rocket ship that's fueled by dividends. It is literally the difference between having a flat tire and having a launch pad. One strategy left you stranded on the side of the road for 18 years. The other one was actually building you real wealth the entire time.
And look, this isn't just some magic trick that only works during the bad times. Even across the entire 110-year period, including all those massive roaring bull markets, dividends were responsible for an incredible 40% of the total return investors got. They are not a sideshow. They are a main event.
So,
How in the world does this work? Well, it's actually a beautifully simple process. You've probably heard of it, the snowball effect. The longer you let it roll, the bigger and faster it grows.
First, just so we're crystal clear, what even is a dividend? It's real cash. Simple as that. When a company turns a profit, it can decide to share a slice of that profit directly with you, the person who owns a piece of the company. You're getting paid simply for being an owner. Now here's where the magic really happens. It's this simple, powerful loop. Step 1, you get paid that cash dividend. Step 2, you turn right around and use that cash to buy more shares. And step 3, this is the key. You now own more shares of the company without putting in a single extra penny of your own money. This creates this amazing cycle. The next time a dividend is paid, your check is bigger because you own more shares. That bigger payment then buys you even more shares, and that snowball just keeps getting bigger and bigger as it rolls downhill. And hey, as if that wasn't enough, there's another huge benefit. The kinds of stable, profitable companies that can afford to pay dividends also tend to be tougher, more resilient businesses. And historically, during market crashes, these high dividend stocks have actually fallen way less than the rest of the market, which gives you this crucial cushion of protection right when you need it most. So what this all leads to is a fundamental shift, a totally new way to think about investing. It's about moving away from being a speculator who's just betting on which way prices are going to go and becoming more like a business owner who is methodically collecting income.
And this isn't just some abstract theory. This explains so much of the anxiety and fear we see in the real world today. After the big crashes in the 2000s, stock ownership in the US just plummeted. Why? Because people got burned. They were playing the price game, waiting for stocks to go up, and they got scared. They were afraid to get back in because they're stuck in that old, price-focused way of thinking.
So this right here, this is the crucial takeaway. The old mindset is a stressful guessing game. You're trying to predict the unpredictable. The new mindset, though, is a patient, calm process. You're not a gambler at a casino, you're a gardener, carefully growing an income-generating machine, one dividend at a time. And it's a machine that works for you in the good times and, most importantly, protects you during those long, brutal winters in the market.
So I'll just leave you with this one question to think about. When you look at your own portfolio, your own investments, what game are you playing? Are you betting on price, or are you building an income stream? Because the answer to that question could make all the difference over the next 10, 20, or 25 years.
So, what if I told you the secret to building wealth has nothing to do with finding the next hot stock that's about to shoot to the moon? What if, instead, it's about something quieter, way more patient, and honestly, a lot more powerful, especially when the market seems to be going absolutely nowhere?
Okay, let's just dive right into this quote from Warren Buffett. I mean, it sounds pretty extreme, right? But this is the key to a completely different way of thinking about investing. See, it's not about the frantic buying and selling. It's about owning. It's about investing in such solid businesses that you truly wouldn't care if you were locked in for years, because their value isn't just tied up in a flickering stock price.
And believe it or not, this isn't just some thought experiment. It actually happened. Back on July 31st, 1914, with World War I on the horizon, the New York Stock Exchange just shut down completely, and it didn't open again for over 4 months. Now, as you can imagine, the speculators, they were panicking. But one group of investors, they weren't worried at all. They were the ones who owned dividend-paying stocks because even with the market doors chained shut, their dividend checks just kept on coming, right on schedule.
Now, a closed market, that's a pretty rare thing. But it's way more common, and honestly a lot more frustrating for most people. A market that is open every single day, but its price just goes sideways for years. This really throws a wrench in that popular idea that, in the long run, stocks always go up.
No, really think about this for a second. Could you personally stick to your investment plan if, after almost 2 whole decades, the market's price was basically right back where you started? It sounds like an absolute nightmare, but it's not a hypothetical. It's a historical fact.
Let me introduce you to this number, 995. That was the peak of the Dow Jones Industrial Average way back in January of 1966. For 17 long years, the market would dance around this number. It would go up, it would go down, but it wouldn't decisively break through and stay there until December of 1982. Imagine that, 17 years of going absolutely nowhere on price.
So this long grinding period, it actually has a name. It's called a secular bear market. And that word secular is just a fancy way of saying long-term. It's not a sudden crash. It's more like a slow, frustrating grind, where price appreciation, the one thing most people are focused on, just vanishes. And that period from 66 to 82, yeah, that was no fluke. Just look at this timeline. Over the last century or so, we've had 4 of these massive secular bear markets. Some of them have lasted for a quarter of a century. The point is, these sideways markets are not weird one-offs. They are a totally normal, recurring part of the investing landscape.
All right, so if you can't count on prices just going up and up forever, what's left? What can you rely on? Well, this is where a completely different kind of investor comes into play. This is someone who actually thrives in these exact conditions simply by shifting their focus away from price and on to payouts.
Think about it like this. On one hand, you've got the speculator. This person is glued to the screen, stressed out about every little price swing and trying to guess what the market's going to do next. Their entire strategy depends on prices going up. But on the other hand, you have the income investor. They're focused on the cash flow, the real money their investments are generating, the dividends from stocks, the interest from bonds. They literally get paid to wait, earning a real return even if the market goes nowhere.
And this whole idea, this powerful difference in mindset, that is the core concept from the book we're exploring today, Timothy McIntosh's The Snowball Effect. The book argues that this income-first approach isn't just some defensive move. It's an incredibly powerful engine for building real wealth.
Okay, so how does this engine actually work? How do you turn a flat, boring market into a huge win? It all comes down to one simple, powerful idea with a name that makes perfect sense: the snowball effect.
Right. We all know how a snowball works. You start with a little ball of snow, you give it a push, and as it rolls downhill, it picks up more snow, getting bigger and bigger, faster and faster. Well, the verb means exactly that, to grow at an accelerating rate.
Let's break down how this works in practice. It's super simple. Step 1, your investment pays you a little bit of cash, like a dividend. Step 2, and this is the crucial part, you don't spend it. You immediately use that cash to buy another tiny piece of the same investment. So step 3, now you own more shares, which means your next dividend payment is going to be slightly bigger. You just repeat this process over and over for years, and that tiny, growing income stream starts to compound and accelerate, just like a snowball rolling downhill.
And here's a crazy bit of trivia for you. Do you want to know the first time the word snowball was used as a verb in a financial context? It was in the Denver Post on the day of the great market crash of 1929. How ironic is that? They were using it to describe how investor debt had snowballed out of control and ended up crushing them. It's a perfect example of how compounding can work against you. But the income investor just flips that whole idea on its head and makes it a powerful force for good. So what happens when you start thinking this way? It completely changes your relationship with the single most important variable in investing: time. For a speculator, a long flat market is a total waste. It's a lost decade. But for an income investor, it's a golden opportunity.
As the author Timothy McIntosh puts it so well, time becomes your best friend. Every single year that the market goes sideways is just another year for you to collect those cash payments and reinvest them, rolling your snowball bigger and bigger and bigger, often scooping up shares at great prices.
All right, let's wrap this all up with the key takeaways. First, start seeing those sideways markets not as a threat, but as an opportunity to accumulate. Second, stop obsessing over daily price noise and focus on the income your portfolio is generating. Third, reinvest every single penny of that income. That's how you get the snowball rolling. You let time and compounding do all the heavy lifting for you. Because at the end of the day, patience beats prediction, every single time. So I'll leave you with this one last question to really think about. Take a hard, honest look at your own investments. If stock prices were completely flat for the next decade, I mean zero price change, would your net worth actually go up? Would your portfolio grow? If the answer is no, well, then maybe it's time to start thinking about building your own snowball. All right, let's just jump right into it. We're going to tackle one of the biggest and maybe one of the most dangerous pieces of financial advice out there. You know the one. The idea that the stock market is this surefire, guaranteed path to getting rich. But is it really that simple? Let's take a closer look. The market always goes up. I mean, you've heard this a million times, right? Your financial advisor says it, you see it on TV, your uncle probably says it at every family get-together. And to be fair, if you zoom way, way out, like over 100 years, there's a tiny grain of truth to it. But as an actual strategy for your life, which, let's face it, doesn't last for centuries, this idea is a massive oversimplification. And this is where that simple little myth just completely falls apart.
What if your long run was 25 years of pretty much zero growth? I mean, really think about that. You invest your money, you do everything you're supposed to do for a quarter of a century, a huge chunk of your career, and you end up right back where you started. And this isn't some made-up scenario. This has actually happened. And understanding why, well, that's the whole ballgame.
So to really get this, we have to introduce a totally new idea: secular cycles. You have to stop thinking of the market as some rocket ship that only goes up. Instead, think of it like it has seasons. You know, you have these incredible, booming summers, but you also have these long, cold winters where basically nothing grows at all.
And there's an official name for these long market winners, a secular bear market. This is a really stubborn, multi-year, sometimes even multi-decade period where the market just treads water. It'll go up a bit, it'll go down a bit, but it just can't seem to break through its old peak and stay there. It's just a long, long period of going nowhere.
And look, this is not some rare, once-in-a-lifetime event. This slide lays out the cold, hard data. Just look at these time frames. 18 years of negative returns starting in 1906. An incredible 25 years of basically zero price growth after the 1929 crash. Another 18 years of nothing from 1966. And yeah, even in our lifetime, the 11 years after the dot-com bubble went absolutely nowhere. These aren't just little dips. These are entire investing careers.
Okay, but here's the part that is just mind-blowing. When you add up all those long flat periods, all those market winters, they make up almost 70% of the entire 110-year period that was studied. Let that sink in for a second. For the huge majority of modern history, the market wasn't soaring. It was just stuck. And this chart right here, from 66 to 82, this shows you exactly what one of those winters looks like. So put yourself in this picture. It's 1966, you're 30 years old, you're starting to save for retirement, you're doing the buy and hold thing everyone tells you to do. And for the next 18 years, the prime of your career, you watch the market do this. Just churn sideways. By the time it finally breaks out, you're almost 50. You've basically lost 2 decades. So, the big question is, what's causing these long winters? Is it, a bad economy? Are companies not growing? Well, the answer is actually a lot simpler than that, and it really comes down to just one thing: the price you pay when you start. It's all about valuation.
Now, the main tool we use to figure this out is the price-to-earnings ratio, or PE ratio. It's actually a really simple idea. It just asks, how much are people willing to pay for $1 of a company's earnings? Just think of it like a price tag. Historically, the average price tag for the market is about 15. If the number is a lot higher, stocks are expensive. If it's lower, they're cheap.
Okay, this slide is everything. It compares 2 different eras, side by side. On the left, you've got that long bear market. It started when stocks had a high price tag, a high PE ratio, and the result? Terrible returns. Now look at the right, a massive bull market. And when did it start? When stocks were cheap, a low PE ratio. The result? Fantastic returns. But here's the real kicker. Company earnings were actually growing faster during the bad period. It didn't even matter. The starting price tag was everything.
So the rule here is pretty simple. A high starting valuation is like a huge headwind blowing against your future returns. I mean, think about the peak of the dot-com bubble in 2000. The market's PE ratio hit something like 30. That's double the historical average. That wasn't just a red flag, it was a blaring siren. And what happened next? An 11-year market winter.
All right, so if that starting PE ratio is so critical, is there maybe a better way to get a reading on the market's temperature? A tool that can kind of smooth out all the short-term noise and give us a better signal for the long haul? Well, it turns out there is.
And it's called the CAPE ratio. It was developed by a Nobel Prize winner, Robert Shiller. So instead of looking at just 1 year of earnings, which can jump all over the place, CAPE looks at the average of the last 10 years of earnings, and it adjusts for inflation. This gives you a much smoother, much more stable picture of whether the market is genuinely cheap or expensive compared to its real long-term ability to make money.
And this chart just shows you how incredibly powerful the CAPE ratio is at predicting things. I mean, the pattern is crystal clear. Just follow the bars from left to right. See how when the starting CAPE ratio is low over on the left, the future 10-year returns are amazing? But as you move to the right, as that starting CAPE gets higher and higher, future returns just completely collapse. The pattern is undeniable. High starting valuations have historically led to really miserable returns down the road.
So what does this all mean for you and me? It means we've got to throw out that old, way too simple myth and replace it with some new, smarter wisdom. The kind of wisdom that actually accepts the reality of these long market seasons and helps us get ready for the winters.
So let's just recap what this new wisdom looks like. Number 1, the market moves in long seasons, these big secular cycles. Number 2, those flat winter periods can last for decades and they happen a lot more than you'd think. Number 3, that starting price tag, your PE or CAPE ratio, is the single best clue you have about your long-term returns. And finally, all this means that a simple buy and hold strategy might leave you just sitting there treading water for years and years.
Which brings us to the most crucial point of all. The most important thing any of us can do as long-term investors isn't just to cross our fingers and hope for the best. It's to have a real, actual strategy for surviving and maybe even finding opportunities during these market winters. Because they are not an exception to the rule, they are the rule. They're a fundamental part of how markets work.
So I'm going to leave you with this question to chew on. Now that you know that a market winter isn't just a little blip, but a full-blown season that can last for 10, 15, even 20 years, how does that change the way you think about your own investments? How are you going to prepare?
All right, let's dive in. Today, we're talking about a part of investing that, often gets pushed to the side for the flashier, high-flying growth stocks. But as you're about to see, it might just be the single most important key to long-term success. We're talking about the unsung and seriously underestimated power of dividends. And let's kick things off with a quote from a guy who knew a thing or two about making money, John D. Rockefeller. He wasn't chasing the next hot trend. He cared about cash. Cold, hard, predictable cash payments hitting his account. And that really sets the stage perfectly for what we're talking about today, the real, tangible value of dividends. So, picture this for a second. Imagine you invest your money, you do everything right for 2 full decades, but at the end of all that time, the stock market has gone absolutely nowhere. Your portfolio is worth the exact same amount as when you started. Sounds like an investor's worst nightmare, right? Well, it's not just a nightmare. It's a very real possibility. So, here's our game plan. We'll start by looking at these lost decades in the market. Then we'll see how dividends can act as a shield against them. We're also going to jump into the great dividend debate among economists, break down exactly how you get paid, and finally, wrap it all up by looking at the full dividend advantage. First up, the market's lost decades. This is all about what happens when stock prices just tread water for years and years and years. And here's the thing you've got to understand. These aren't some kind of black swan, once-in-a-century event. No. These long stretches where stock prices go nowhere, they're called secular bear markets, are a totally normal and reoccurring feature of investing. Chances are, if you're an investor, you're going to live through at least one of these. So, if stock prices can literally go nowhere for over a decade, how in the world are you supposed to make any money? Well, that brings us to the hero of our story. The bear market shield. Okay, check this out, because this slide tells an absolutely incredible story. Look at these 4 long stretches of time. The middle column, price return, is basically zero, flat, nothing. But then, look at the column that includes dividends. The returns completely flip. You go from making nothing to making really solid positive returns. We're talking almost 5, 5.5, even over 6% a year, all while the stock prices themselves were going absolutely nowhere. It's insane. And it's not just about getting through the tough years either. If you zoom out and look at the big picture, it's just as powerful. Over the last 110 years, a whopping 40% of the total return from the stock market came directly from dividends. Not from soaring stock prices, but from these steady, reliable cash payments. And get this, it can get even crazier. In some decades, like the Great Depression in the 30s or the dot-com bust in the 2000s, stock prices actually went down. In those periods, dividends didn't just help, they were everything. They were literally the only thing providing a positive return, making up for more than 100% of the total return. Now, after seeing all that, you'd think every single person would agree that dividends are amazing, right? But, this is finance, so of course it's not that simple. And that brings us to the great dividend debate. At the core of this whole thing is a mystery called the dividend puzzle. An economist named Fisher Black basically asked, look, since dividends can often have worse tax treatment than selling a stock for a profit, why on earth do companies bother paying them? And why do investors get so excited about them? On paper, it can seem kind of irrational. So this puzzle really created 2 main camps. On one side, you've got the bird in the hand theory.
This says, hey, investors aren't dumb. They prefer the certainty of cash in their pocket today, the bird in the hand, over the risky promise that the stock price might go up later. But on the other side, you have the dividend irrelevance theory. It argues that a company's dividend policy doesn't matter at all. If you want cash, just sell a few shares.
And then there's a third angle, which is all about taxes. The tax preference theory basically says that since capital gains, that's the profit you make when you sell a stock, are often taxed at a lower rate, and you only pay that tax when you decide to sell, investors should want companies to reinvest profits for growth, not pay them out as dividends.
Okay, that's enough theory. Let's get down to brass tacks. How does a dividend actually make its way from a company's bank account into yours? Let's walk through the whole process, from declaration to payout. So what exactly is a dividend? Super simple. It's just a piece of a company's profit that its board of directors decides to hand out to the people who own the company, the shareholders. It's almost always paid in cash, and you get a specific amount for every single share you own. And the payout follows 4 P dates you've got to know. First is the declaration date. That's just when the company announces it's going to pay. The next one is the big one for you, the investor, the ex-dividend date. You have to own the stock before this date to get the dividend. If you buy it on or after this date, you're out of luck. Then there's the record date, when the company officially checks who owns what. And finally, the best day of all, the payment date. That's when the money shows up. So we know dividends can be a lifesaver in a flat market. And now we know how they work. But wait, there's more. Let's circle back to the dividend advantage, because it's about so much more than just getting a check in the mail. Okay, here's the question on every investor's mind, especially when things get rocky. What happens in a crash? How do these stocks actually hold up when the market is in a total freefall? Well, this chart pretty much says it all. The data shows that high dividend stocks tend to act like a cushion. Now, they still go down, let's be clear, but on average, they fall about 19% less than the rest of the market. That's real, tangible downside protection when everybody else is panicking. There's actually a fancy term for this. It's called the downside capture ratio. All it means is, if the market falls 10%, how much did you fall? A ratio of 100 means you fell the full 10%. A ratio below 100 means you fell less. And what we see is that historically, high dividend stocks have captured only about 81% of the market's fall. And here's the kicker. The final, crucial advantage, growth. See, dividends aren't just a fixed payment. Good, healthy companies make it a top priority to increase their dividend every single year. Let's go back to that brutal 16-year flat market from 1966 to 82. During that time, the companies in the Dow actually grew their dividend payments by almost 5% per year. Think about that for a second. Even when stock prices were going nowhere, your income from those stocks was growing. So when you put it all together, the ability to generate returns when the market is flat, the power to act as a cushion during a crash, and the capacity to actually grow your income over time, it all leads to one really important question you should ask yourself. Is your portfolio built to survive a lost decade? What if I told you there's an investment strategy that actually gets stronger when the market gets weaker? A way to build wealth, even if your stock's price goes down. Today, we're going to dive into a really powerful concept that can turn market downturns completely to your advantage. It's called the snowball effect. All right, so to really get this, we've got to start by looking at a pretty strange trend. Even as the stock market has been hitting new highs, a surprising number of people are actually running for the hills. Just take a look at this graph from a Gallup poll. Ever since the big financial crisis in 2008, that green line shows a really clear, steady drop in the number of Americans who are invested in the market at all. It's kind of wild. A massive retreat happening right in the middle of a huge bull run. By 2016, that number hit a shocking low. Only 52% of Americans owned any stock. Think about that for a second. That means nearly half the country was sitting on the sidelines. This actually matches the lowest point in the poll's entire 19-year history, a huge drop from that peak of 65% right before the crisis. So, this brings up a really big question. With markets going up and up, why are so many people choosing to stay away? What gives? What are they so afraid of? Let's talk about the consequences of that fear. Because as it turns out, playing it safe comes with its own pretty significant and often hidden price tag. That 2008 financial crisis, man, it left a deep scar. It totally shifted our collective appetite for risk. For so many people, the main goal isn't about growing their wealth anymore. It's just about not losing it. And that fear, it has real consequences. I mean, look at this number. It's led to a record $10.1 trillion just sitting in cash and low-risk accounts like savings and CDs. And that money is earning basically nothing. In fact, it's often losing buying power to inflation year after year. And this slide, wow, this really shows you the opportunity cost. A lot of people think real estate is the best long-term play, but the numbers here tell a very different story. Over almost 40 years, a stock market investment with the dividends reinvested beat real estate 3-1, not even close. And you know what makes it even worse? That fear often leads to really bad decisions. Studies show again and again that investors who try to jump in and out, selling in a panic and then trying to buy back in later, they consistently do worse. They make way less money than people who just buy and hold on. So, if trying to time the market based on fear is a total bust, what's a better way to do it? Well, this is where things get really interesting. This brings us to the core of this whole idea, shifting your focus from the daily price to the power of the dividend snowball. I love this quote from the legendary T. Boone Pickens because it just nails the mindset shift we're talking about. It's about seeing your stocks not just as something you hope to sell for more money later, but as an asset that's generating a real, steady, and growing stream of income for you. And the engine that makes this all work is something called dividend reinvestment. It sounds a little fancy, but honestly, the concept is so simple, it's brilliant. Instead of taking the cash dividends a company pays you, you just automatically use that money to buy more shares of that same company. And here's how that cycle works, step by step. It's this awesome, self-feeding loop. You own shares, which pay you dividends. Those dividends buy you more shares. And those new shares, well, they pay you even more dividends next time. It's exactly like a snowball rolling downhill. It just keeps getting bigger and faster, all by itself. Okay, that's the theory, but let's see how this actually plays out in the real world. We're going to use a company we all know, Pepsi, and see how this strategy can build some incredible wealth, even through some really crazy times in the market. So imagine it's the year 2000. You've got $100,000 and you decide to put it all into PepsiCo stock. And you set one simple rule. You're going to reinvest every single dividend you get. So that $100,000 gets you 2,680 shares. Now, fast forward 15 years. You haven't put in another dime of your own money, but just by letting those dividends do their thing, you now own 3,853 shares. You grow your ownership by over 1,000 shares automatically. But this is where it gets absolutely wild. This is the part that feels totally backwards, but it's the secret sauce. Look what happened during the 2008 crisis. In 2007, when the price was high, your dividends bought you 68 extra shares. Fine. But in 2008, when the market completely crashed and the price was low, that same dividend payout bought you 106 shares. The market crash literally accelerated your snowball's growth. So after all that, what's the bottom line? After 15 years of just letting this thing run on autopilot, that original $100,000 investment snowballed into a total value of almost $385,000. It nearly quadrupled just by focusing on accumulation, not the daily price. Okay, I know what you're thinking. Sure, that works great for a stock like Pepsi that did well, but what happens if you try this with a stock that was, well, a dud? A stock whose share price actually went down? Is it possible to win while you're technically losing? So let's really put this to the test. We'll run the exact same scenario, $100,000 in the year 2000, reinvesting all the dividends for 15 years. But this time, we're doing it with Northern Trust Bank stock. And spoiler alert, on paper, this stock was a loser over this period. Now get this is just mind-blowing. Over those 15 years, Northern Trust's share price actually fell by more than 10%. If you just bought the stock and held it, your $100,000 would have shrunk. But because you kept reinvesting those dividends, buying more and more shares, especially when the price was low, your total investment actually grew to over $113,000. You made money on a losing stock. That is the power of this strategy. Okay, so we've seen how this works with a winner and even with a stock that was a loser on paper. The logical next question is, right, how do you find these kinds of snowball companies for yourself? Well, you want to look for a few key ingredients. First, a solid track record. Has the company been paying dividends for a long, long time? That shows commitment. Second, are they consistently growing those dividends? That's huge.
You also want to see that they aren't paying out too much of their profits, so they have plenty of room for future increases. And finally, finding a stock with an above-average yield for its industry can be a really great sign. So at the end of the day, it really all comes down to this one question. This whole idea is about a fundamental shift in how you think about investing. Are you going to stress out about the daily ups and downs of the stock price? Or are you going to focus on the long game, on steadily growing your income machine, on growing your snowball quarter after quarter, year after year? The question is no longer, what did the market do today? It's, how much bigger is my snowball? Hey, welcome back. For decades, there's been this simple rule in investing you've probably heard a million times. If you want bigger returns, you've got to own small cap stocks, right? It's been a cornerstone of financial advice for years. But what if that rule is just wrong? Today, we're going to dig into the real data behind this long-held belief. So let's take a page from Nietzsche's book and be a little skeptical. We're going to put on our detective hats, question this piece of conventional wisdom, and see if this so-called small cap advantage actually holds up when you really look at it. Okay, first things first, let's make sure we're all on the same page. Market cap. It just sounds complicated. It's really just a way of saying how big a company is. So think of it this way. A company with 1 billion shares out there, and each share is trading for $50, well, that's a $50 billion company. That's a large cap. But another company with only 1 million shares at that same $50 price, its market cap is just 50 million. And that's your classic small cap. It's all about the total value, not the price of one share. Now here's the promise, the theory that's been sold for years. Smaller companies, they're just riskier by nature. They don't have the deep pockets of the big guys. They're more likely to get knocked around by a bad economy. And yeah, their stock prices can be all over the place. So to get investors like you and me to take on that extra risk, the market is supposed to offer a reward. Higher returns. It's often called the risk premium. Makes sense, right? Simple, logical. But does that simple, logical promise actually hold up in the real world? This is where the story takes a really sharp turn. Because when we start looking at the actual numbers over the past few decades, a paradox pops up that basically challenges everything we thought we knew. Yeah, just look at this. This shows the complete opposite of what the theory predicts. And these aren't just one-off bad years. We're talking about long stretches of time. From 84 to 91, large caps returned almost triple what small caps did. Then, during the dot-com boom in the late 90s, small caps lagged behind by 8% a year, and it happened again from 2012 to 2015. These are serious, multi-year periods where small caps got absolutely crushed. Okay, let's make this even more real. Let's say you invested $100,000 way back at the end of 1978. You put it all into a small cap portfolio, and you just let it sit there for almost 40 years. Where do you think you'd end up? By the end of 2015, that $100,000 in small caps would have grown to just over $370,000. Not bad, right? I mean, you more than tripled your money. But just wait. Because if you'd put that same $100,000 into large cap stocks instead, it would have grown to almost $600,000. That's a difference of over $227,000. That is a massive, massive gap. So the supposedly superior investment class actually left you way behind over the long run. Which brings us to the big question. I mean, what on earth happened? Where did this so-called small cap advantage go? Why did a theory that sounds so good on paper just completely fall apart in the real world? All right, let's start peeling back the layers of this mystery. It's a fascinating story that starts with this famous academic study and pretty much ends with the whole effect disappearing once everybody found out about it. And this timeline, it tells the whole story perfectly. So back in the early 80s, a researcher named Rolf Banz drops this bombshell study showing small firms had this huge 20% performance edge. The investment world, of course, went nuts. But then in 1983, another researcher finds that nearly half of that entire advantage happened in just 1 month, January. It was likely just people selling stocks for a tax loss in December and then buying back in. And guess what? Once the secret was out and small cap funds started popping up everywhere, the advantage just faded away. By the 2000s, new studies basically confirmed it. The effect was gone. So why did it just vanish? Well, there are a bunch of really good reasons. First, popularity. It's a classic case of an advantage disappearing once everyone tries to do it. Then you have that weird January anomaly we just talked about. But there's more. Trading costs for these smaller, less traded stocks can be shockingly high, sometimes over 7%, which can just eat up your profits. And get this, the historical data was often flawed because it would just ignore companies that went bankrupt and got delisted. Finally, the whole game changed. Today, giant investment funds dominate the market, and they overwhelmingly stick to big, liquid stocks they can trade easily.
Okay, so the higher returns part of the promise, it didn't really pan out. But what about the other side of the deal? The whole theory was higher returns for higher risk. We've poked some serious holes in the returns part, so now let's take a closer look at the risk. And this right here is pretty much the final nail in the coffin for that simple old rule. This chart shows volatility, which is just a fancy way of measuring how bumpy the ride is. And yeah, small caps were way more volatile, a lot more stomach churning at 19.5% compared to just 15.1% for large caps. So let's get this straight. Small cap investors got lower returns and had to deal with higher risk. I mean, that's the textbook definition of a bad deal.
But hold on. Does this mean the entire small cap universe is just a lost cause? Or could it be that if we dig a little deeper, we might find a specific corner of this market where the old logic actually still makes sense? Let's take another look, but this time with a more critical eye.
So when you peek under the hood of the most common small cap index, the Russell 2000, something really jumps out. A whopping 68% of these companies don't pay any dividend at all. So right away, if you're an investor who cares about getting income and a sign of company stability, 2/3 of the index is already off the table. Only about a fifth of them pay what you'd call a meaningful dividend.
And this is where it gets really powerful. If you split the group up, you take the dividend payers and separate them from the non-payers, a crystal clear pattern shows up. The companies that paid no dividends, they returned just 8.2% a year. But the ones that did pay dividends, they returned 11.2%, easily beating the index itself. This is huge. It shows that not all small caps are the same. Zeroing in on companies that actually share their profits has historically made all the difference. And there's one more little niche to look at, microcaps. We're talking about the smallest of the small. Now, they're much smaller and harder to trade, but the key thing here is something called correlation. Basically, how much do they move in sync with the big stocks? Small caps have actually started moving more and more like large caps, so they don't offer as much diversification as they used to. Microcaps, though, they have a much lower correlation, and it's been decreasing. That makes them a potentially much better tool if what you're really looking for is true diversification for your portfolio. So after going through all of this, what's the real lesson here for an investor who's just trying to make sense of this paradox? How do we put these pieces together into a strategy that actually works?
Well, the first and most important takeaway is this. That old, simple rule of thumb that small equals better for higher returns is, at best, totally outdated, and at worst, it's just plain wrong. The data simply doesn't back it up anymore.
So what's the smarter play? First, we have to look past these simple, broad labels like small cap. The category is just too big to be useful. Second, focus on quality. As we saw, things like a company's ability to consistently pay a dividend made a huge difference in returns. And third, if your main goal is diversification, you need to look for assets that have genuinely low correlation, which, as we just saw, might lead you to a niche like very carefully chosen microcaps.
Which leaves us with one last big idea to think about. This whole small cap paradox teaches us a really powerful lesson that goes way beyond just this one corner of the market. It forces us to ask, in a world that is always changing, is the biggest risk we face as investors just blindly following old rules without ever stopping to question if they're even true anymore?
Welcome to The Explainer. Today, we're going to talk about something that gets a bad rap for being, well, kind of boring. We're going to unlock the surprising power hidden inside one of the most misunderstood investments out there, bonds.
You've probably heard this famous quote about compound interest being the eighth wonder of the world. It's this incredibly powerful idea. But here's the real question. How do you actually put that force to work for your money? I mean, beyond just a basic savings account, right?
Well, the answer might just be hiding in plain sight. In that very thing, a lot of people write off as too complex or, yeah, even a little bit boring.
Okay, so here's how we're going to break it all down. We'll start from square one and build our way up to the real secret sauce of how these things can actually build your wealth.
First up, let's tackle a huge piece of common wisdom you hear in investing. You know the one, stocks are the only way to really grow your money. But let's be real, anyone who's been at this for a while knows stocks don't just go up in a straight line. And when you hit those long, flat periods where the stock market is just treading water, you need something else. You need a source of dependable, predictable income. And that's where bonds can come in, giving you that steady stream of cash.
Okay, so we know they can provide the steady cash, but what is a bond really? Let's cut through all the financial jargon and get right down to what it is at its very core.
Honestly, the easiest way to think about it is like an IOU. That's it. You're lending money to a company or a government, and in return, they promise to pay you back with interest, of course.
And that interest, your reward for lending them the money, it has a specific name, the coupon. It's just a fancy word for the fixed interest payment you get, typically every 6 months. Simple as that.
And finally, there's maturity. That's just the end date, the day you get your original loan, your principal, paid back in full. So see, it really is that simple. You lend money, you collect interest payments, and then you get your money back.
But, and this is where it gets really interesting, a bond's price isn't set in stone. After it's issued, it trades on the open market, and its price can go up or down. And if you understand this one little detail, it unlocks a super powerful tool for investors.
So a bond can sell at a premium, more than its face value, or, and this is the important one for us, it can sell at a discount. This means you could buy that $1,000 IOU for something like, say, $925. Now, why would that happen? Well, imagine new bonds are coming out with higher interest rates. Suddenly, that older bond with its lower rate isn't as appealing, so its price has to drop to compete.
And this idea of buying at a discount leads us to probably the most important number for any bond investor. It's called yield to maturity, or YTM for short. You can just think of it as your total return. It's so powerful because it doesn't just look at the interest payments, it also factors in that sweet discount you got when you bought it.
Okay, now look at this chart. This is the magic I'm talking about right here. So you have that bond paying 4% interest, which is $40 a year. But because you only paid $925 for it instead of the full $1,000, your actual return, your YTM, jumps all the way up to almost 5%. You're getting the interest plus the built-in profit from buying it on sale. It's a double win.
Okay, so that sounds pretty good, right? But where do you actually find these things? Well, for most investors, it boils down to two main types, and there's a really important difference between them.
You've got your government bonds, think U.S. treasuries, which are considered super safe. And then you have corporate bonds, which are issued by companies. Now, these have a little more risk, but to make up for that, they have to reward you with higher interest payments.
But here's the catch. In the world we live in today, with interest rates being so low for so long, that super safe option, government bonds, well, they just don't pay very much. The returns can be pretty tiny, and that leads a lot of investors to ask a big question.
Are those higher payments from corporate bonds really worth the extra risk?
I mean, the number one fear, right? It's default risk. What if the company just can't pay you back? What if it goes bankrupt? It's a scary thought. So let's look at the data. How big is that risk, really?
And honestly, the numbers might surprise you. If we look at what are called investment-grade corporate bonds, we're talking about bonds from big, stable companies here, the average default rate, historically, has been less than 1%. So that fear we all have, it's often way bigger than the actual reality.
Now, this chart, this is so important. It gets to the very heart of how bonds make money. Look at that. Over the long run, a whopping 95% of the total return you get from bonds doesn't come from trying to time the market or guess which way prices will go. Nope, it comes from one thing, those steady, predictable, reliable income payments.
So think about it like this. If that steady income is the engine, how do we add rocket fuel to it? How do we make it truly powerful? Well, that brings us to the grand finale, the most powerful idea of all, reinvestment. Putting that income back to work.
Let's look at an example. Say you invest $10,000. If you just collect all the interest payments and spend them, over 20 years you double your money to $20,000. Hey, that's not bad at all. But what if you took every single interest payment and immediately used it to buy more bonds? Well, then you create a snowball effect. Your interest starts earning its own interest, and look what happens. That same 10 grand grows to nearly $27,000. That is the power of compounding in action.
That difference, that nearly $7,000, that's the magic. That's pure profit that your money earned all by itself, simply because you put it back to work. It's an incredibly simple concept, really, but it leaves us with a huge question to think about. How could this snowball effect change your own financial future?
Welcome to The Explainer. Today, we are diving into a really cool strategy that can help you generate more income from stocks you already have sitting in your portfolio. It's a powerful tool, especially for long-term investors, and it's called the covered call strategy. Let's kick things off with this quote, because it perfectly captures the whole mindset here. This isn't about trying to time the market perfectly or chasing some massive speculative jackpot. Nope. It's about a disciplined, smart approach to generating consistent income. I mean, this is the big question, right? If you're a long-term investor and your goal is to buy and hold good companies and collect those dividends, you've probably wondered, is there a way I can squeeze a little more juice from my portfolio? Well, covered calls offer a really fascinating answer to that. So here's our game plan. We've broken this down into 5 simple parts. We're going to start with why you'd even want to do this, then cover what a covered call actually is and how it works with a real company. After that, we'll look at all the possible outcomes, the good, the bad, the whole shebang, and we'll finish up with a simple playbook of rules to follow. Okay, let's jump right in. And the best way to get this is with a simple analogy that honestly makes the whole thing just click. Think of yourself as a landlord, but for your stocks. So here's the deal. You own the asset, right? In this case, at least 100 shares of a stock. By selling a covered call, you're essentially renting it out. You collect an immediate cash payment, the rent, in exchange for giving someone the option to buy your stock at a specific price down the road. It's this extra layer of income, right? On top of any dividends you're already collecting. Now, before we get into the nitty-gritty, we gotta learn the lingo. Don't worry, it's easy. There are just 3 key terms that are the foundation for this entire strategy. Once you get these, you get the whole thing. First up is the call option. Just think of it like a contract. And the magic phrase to remember here is the right, but not the obligation. This means the person who buys this contract from you gets the right to purchase your stock at a pre-agreed price, but they don't have to. Oh, and one contract always represents 100 shares of stock. Next up, the strike price. This one's super simple. It's just the price you both agree on. If the option buyer decides, yep, I want to buy your shares, this is the exact price they'll pay per share. It doesn't matter if the stock is trading higher or lower on the open market. And finally, my favorite part, the premium. This is the cash you get paid to you instantly, just for selling the option in the first place. It's your payment for making the deal. And here's the kicker. You keep that premium no matter what happens next. It's yours. Okay, this is absolutely critical. We need to talk about that word covered. What does it mean? Covered just means you already own the 100 shares of stock that you're selling the option on. That's what makes this a relatively conservative income strategy. The opposite of this is an uncovered or naked call, and that's where you sell an option on a stock you don't own. It is an extremely high-risk, speculative gamble, and it is absolutely not what we are talking about today. All right, enough with the theory. Let's make this real. We're going to use a company we all know, Pepsi, ticker symbol PEP. And for this example, let's just pretend you own at least 100 shares of it. So take a look at this table. It shows you some of the potential options you could sell for Pepsi. And you'll notice a couple of things right away. First, see how the premiums are higher for strike prices that are closer to where the stock is currently trading? And second, the premiums are also higher for options that expire further out in the future. That makes sense, right? You're selling more time. So, for example, if you decide to sell one April call option with the strike price of $105, you'd get a premium of 61 cents per share. And since one contract is 100 shares, boom, that's $61 deposited straight into your account immediately. So you might be looking at that table and thinking, okay, how do I compare all these different options? Well, here's a great little tool, calculating the annualized yield. This simple 3-step formula lets you compare apples to apples. It shows you what your return from just the premium would look like if you could repeat it over a full year. So you did it. You clicked the button, you sold a covered call, the premium is in your account. Now what? What happens next? The great thing is, it's not that complicated. There are really only 4 main scenarios that can play out from now until that option expires. Let's walk through those 4 paths, sticking with our Pepsi example where we sold the $105 call. Okay, path number 1, which is really the ideal scenario for income, the stock just hangs out and stays below $105. The option simply expires worthless. You keep the full $61 premium as pure profit, and you keep your 100 shares. Then you can just turn around and do it all over again next month. Path number 2, you decide to close the position early. Maybe the stock went down a bit, the option's value has dropped, and you want to lock in a quick profit. You can just buy that same option back for less than you sold it for. Path number 3. The stock price rises above $105. In this case, your shares get called away. That just means they're automatically sold at that price you agreed on, $105 per share. You get to keep all the money from the sale, plus that original $61 premium. And path number 4 is a bit more of an advanced move. You can roll the option. This just means you buy back your current option before it expires and sell a new one with a later expiration date, collecting another premium while you're at it. All right, let's pull this all together into a simple playbook. Because to really use this strategy effectively, you have to understand the basic rules of the road, and more importantly, the central trade-off that you are making every single time. And this right here, this is the whole thing, the crucial trade-off. You are knowingly and willingly exchanging potential upside for immediate guaranteed income. That premium you collect, it gives you a small cushion if the stock price goes down. But, and this is the big but, it also caps your potential profit. If that stock absolutely skyrockets way past your strike price, you will miss out on those extra gains. So keeping that trade-off in mind, here are 5 final guidelines. Your checklist. Number 1, only, and I mean only, do this on stocks you are genuinely okay with selling at your chosen price. 2, always pick a strike price that locks in a profit over what you paid for the stock. 3, this strategy just works beautifully with high-quality dividend-paying companies you'd want to own for the long haul anyway. 4, be mentally prepared for your shares to get called away. Don't get emotionally attached if the stock goes up. And finally, number 5, when you're looking at your returns, always remember to add your premium income to your dividend income to see the full picture. At the end of the day, the entire covered call strategy really boils down to this one simple question. Is a guaranteed payment in your hand today worth giving up a potential jackpot tomorrow? This is a strategy for investors who lean towards answering yes to that. It's a conscious choice to prioritize consistent, predictable income over the uncertain lottery ticket of massive gains. And deciding if that trade-off is right for you, well, that's the key. So here's a question for you. What if you could build some serious wealth in the stock market, even if the market itself went absolutely nowhere? Yeah, sounds kind of impossible, right? Well, in this explainer, we are going to break down a really powerful and honestly often overlooked strategy that thrives on consistency, not on trying to guess the next big thing. You know, Winston Churchill really hit the nail on the head with this one. To have any shot at figuring out where the market might be going, you've got to first take a good, long look at where it's been. All right, let's just do a quick thought experiment. Picture this. A full decade of total stock market stagnation. Prices are just flat, no growth at all. For most investors, that sounds like a total nightmare. But what if I told you there's a way to not just survive a scenario like that, but to actually thrive in it? That's the big idea we're going to dig into today. Okay, but before we jump into the solution, we really need to get our heads around the problem. And believe me, it is a big one. It's a challenge facing investors right now that's pretty unique in modern history. See, for most of the last century, dividends, those cash payments companies send out to their shareholders, they were the unsung heroes of investing. I mean, they were a massive engine for growth. But lately, that engine has been sputtering. A big reason is that a lot of companies now prefer to use their extra cash for stock buybacks instead of dividends. And the result? The income you can expect from your average stock has shrunk a lot. And this chart, well, it tells the whole story. Just look. Over on the left, for most of the 20th century, you can see average dividend yields were consistently hanging out above 4%. That's a huge boost to your returns. But as you move your eyes to the right, you see this dramatic fall. That reliable stream of income has literally been sliced in half, landing us somewhere around 2% today. So just to put a fine point on it, we've gone from a 4% yield, which was a major driver of returns, down to just 2% today. That missing 2% is a huge performance gap that investors today somehow need to fill. And here's the other shoe that's about to drop. You might be thinking, no big deal, I'll just make up for it with rising stock prices. Well, the problem with that is with valuations already so high compared to history, a lot of people believe that future returns from just price growth are probably going to be a lot weaker than what we've gotten used to. So here's the bottom line. Both of the traditional engines of growth, dividends and rising prices, are under some serious pressure. So what's an investor supposed to do? Well, this brings us right to the heart of our explainer, a strategy that's actually designed to build wealth in exactly this kind of environment. It's called the Snowball Effect, and the idea behind it is so simple, but it's incredibly powerful. What you do is you shift your focus away from just hoping stock prices go up, and instead you focus on building an ever-growing stream of income. You take every dividend you earn and you immediately use it to buy more shares, which then, of course, generate even more dividends. It becomes this amazing self-perpetuating cycle of growth.
Now, this isn't about just blindly chasing the highest yielding stocks out there, not at all. The snowball strategy looks for companies that check 5 specific boxes. Yeah, you want a good starting dividend, but what's even more important is a history of growing that dividend over time. You also want a company that's reasonably priced, financially rock solid, and tends to be a bit more stable than the rest of the market.
Let's make this real. Take a look at a company like IBM. It has a solid 3% dividend yield, which is good, but the real key is its dividend growth, an amazing 15% over 5 years. It's also got a low PE ratio, which just means it's pretty inexpensive compared to its earnings. And a low beta means its stock price is typically less jumpy than the market as a whole. You combine all that with a top-tier financial rating, and boom, you've got a prime candidate for this strategy.
Okay, the theory sounds pretty good, but does it actually work in the real world? Let's run the numbers on a really fascinating test case from the source material. So here's the setup. We start with a portfolio of $100,000, and it's filled with these high-quality snowball stocks. Then we throw the ultimate challenge at it. For 10 straight years, the stock market goes absolutely nowhere. The price of every single share you own is exactly the same at the end as it was when you started.
So what happens? Well, the results are all about the income. In year 1, the portfolio sped out about $3,600, but by reinvesting those dividends year after year after year, by year 10, that annual income stream just explodes to over $14,000. That is the snowball rolling downhill, getting bigger and faster every single year. And what about the total value of the portfolio? Remember, zero help from the stock market. Even so, that initial $100,000 grew to over $163,000. That's a 63% return that came purely from the power of those reinvested dividends.
You know, this might be the most powerful number of all. By the 10th year, that portfolio was generating 14.3% in annual income based on the original $100,000 you put in. I mean, think about that for a second. You've basically created your own high-yield machine. So the takeaway here is crystal clear. The snowball strategy works. It can generate serious wealth and a powerful income stream completely independent of all the day-to-day chaos of the stock market. It's a return you can actually count on.
All right, so you're probably wondering, how can I actually put this into practice? Well, it's more straightforward than you might think. Let's break it down.
Really, it all boils down to 3 simple, repeatable steps. First, start with quality companies that fit those criteria we talked about. Second, put it on autopilot. Make sure every dividend you get is automatically reinvested to buy more shares. And third, and this is a big one, you got to change your mindset. Your goal is no longer to watch the stock price tick up and down. Your new scoreboard is watching your income stream grow. Of course, no strategy is completely risk-free. You still need to be diversified and be aware of any tax implications. But that's your new obsession, income growth. And hey, if you need one final, absolutely mind-blowing example of compounding, this is it. You've heard the story about the $24 deal for Manhattan, right? Well, if that money had just been invested and the dividends were reinvested, its value today would be, well, it's almost unimaginable. $10,000 trillion. Now that is the truly astonishing power of the snowball effect.
And that really brings us to the final question. The principles are clear, the historical proof is compelling. The only question left is the one you see right here. By starting today, by focusing on income, and by just letting the incredible power of compounding do its thing, what could your snowball look like in 10 years?